the market being defined by large cap, market cap weighting, risk being defined by Trump and tariffs. I think it's the opposite. I think the market is small caps, and I think the risk is Japan.
Hello and welcome to Wealthion. I'm Maggie Lake, and today I'm joined by Michael Guyad, portfolio manager and publisher of the Lead Lag Report. Hey, Michael, thanks for being with us.
I always like talking to you, Maggie, only because I have no one else to talk to during the day.
I find that very hard to believe, Michael. I see you going back and forth with tons of people, and the thing I love about it and why I'm looking forward to this conversation is that you are someone who is not afraid to have a point of view and not afraid to push back or buck the consensus or groupthink out there. So I thought that would be a great framework, right? Let's talk about where you think what you think or where you think investors are missing the point when it comes to both risk and opportunity. So we'll start with the risk side of things, I think, because it feels like that's what everyone's talking about. And we've seen a lot of angst, especially around tariffs. Equity markets have been under pressure or, suffering from bouts of selling. Sentiment numbers are starting to head south, both consumer and in the sort of C-suite and CEOs. And the common reason we hear is tariffs. Are you concerned that tariffs are going to deliver a hit to growth and earnings?
Well, first of all, let's talk about the crowd for a second. And let's be very clear. The crowd is right on average, but wrong at the extreme. And I'd argue there is an extreme in the idea that the stock market has been in a bull market. Last I checked, the majority of the stock market, in terms of the number of stocks, is small cap. And I've been on this theme for the last year and a half, 2 years. And I don't know if anybody's noticed, but small caps are halfway through a lost decade. They've gone nowhere if you look at Russell 2000, right? Obviously, the S&P 500 and market cap weighting has had a very different experience in this run. But it's like, I keep saying small caps hold the key for a reason, because this is supposed to be what's really reflective of the true state and health of the U.S. economy, because these are the small businesses that drive economic growth, that drive economic activity, that drive labor. And the market's clearly saying small caps suck. That seems like a big risk nobody's paying attention to. I've been hammering it for the last, again, year and a half, 2 years, and hasn't mattered, right? At least not yet. Small caps have been doing that before tariffs, right? Like, I get it. A lot of people are seeing the tariff volatility and then seeing that translate into equity volatility. Is there a connection? Yeah, sure. But that doesn't explain the huge divergence in concentration among the top names versus everything else, because that's been an ongoing process pre-Trump. That's number one. Number two, I find it funny that everyone's focusing on tariffs. And if you look at the yen, right, which I talk about ad nauseum because of that reverse carrier trade thesis that I continue to believe is still very real. The yen started rallying early January. If the yen keeps rallying, that tends to mean that there's a disinflate or deleveraging that can happen as money repatriates from the borrowed capital from Japan that goes into risk-on assets, and the currency side now impacts those returns. So is it really tariffs, or is there maybe a stealth reverse carrier trade starting to take place? It's just a deleveraging because the yen is strengthening, and some money that's been borrowing from Japan is worried about the currency conversion now hurting them as the yen improves, right? So the point of me saying all this is that, again, the crowd is right on average, not at the extremes. I think there is an extreme view on what defines the market, and there's an extreme view on what defines risk. The market being defined by large cap, market cap weighting, risk being defined by Trump and tariffs. I think it's the opposite. I think the market is small caps, and I think the risk is Japan.
Okay, so on small caps, you are right that, when we talk about the real economy versus the market economy or the financial economy, that certainly was represented by small caps. Do you feel like there are just some zombie small caps out there? Is this a cyclical small cap stuck and maybe reflective of some economic malaise we haven't identified? Or is this just a new game where you're not really having that same sort of representation in the economy with some of these small caps? Is it different now?
Is it different this time?
Yeah, the famous question, and it never is, but it's always worth asking.
There used to be this saying that a rising tide lifts all boats. I don't know what happened to that.
Yeah.
I've said repeatedly, again, I've been wrong because the market just hasn't cared about it. The market being the S&P 500 in most people's eyes. I've been saying when a rising tide does not lift all boats, everybody drowns. And I get accused of being a perma-bear because I'm saying that. But it's clear as day that you're talking about two totally different markets. Now, you could argue that that's a feature, not a bug, of market cap weighting. I think it's actually very much a bug because that ends up kind of self-correcting, because as more and more concentration gets driven by a select number of companies, the Pareto principle within the Pareto principle, 80-20 within the 80-20, it actually creates a hell of a lot of systemic risk, because then the entire, in quotes, wealth effect is being driven by idiosyncratic dynamics with a select number of large companies, which means the moment the S&P 500 goes down 15, 20, 25, 30%, and it forces the Fed to pivot, who is the Fed saving? Is the Fed saving the stock market or the drivers of the market cap weighted averages, meaning they're just saving individual companies, at the very top,
yeah,
right? While everyone else largely, struggles. Now, having said that, I do believe that, let's talk about the positives for a second. I do believe that deregulation is ultimately going to be beneficial towards small caps. I do believe that tariffs, you can argue, should benefit small caps because it's about trying to force some money into the domestic economy from international exports, right? Yes, it's inflationary, sure. But at the same time, I do think that there's a longer term argument for small, mid value, non-tech to be sort of the next leader under the Trump administration. But clearly it hasn't happened yet.
So when you're talking about, so for folks listening, just to clarify a couple of those points, when you're talking about, okay, small caps represent the U.S. economy, they're thinking, oh, well, the S&P 500, the 500's biggest companies, but you're saying because of market weight, that's kind of an illusion. And actually, the same drivers of the NASDAQ are in the S&P 500 and all of the concentration. Yes, there are 500 companies, but really everybody's jammed in mega cap tech, right?
Yeah, and but you can see that even from international allocations. It's like, it's not just U.S. Flow that's going into the top names. It's a lot of sovereign governments.
Right. And that's the other point, that the rally you're sort of making with this argument is that the rally we've seen, while some people say, well, stock market's doing great, so the U.S. is doing great, so the U.S. economy is doing great. Not necessarily. It's more a reflection of that's where the capital flows have been good.
Right.
And the returns have been good for that capital, but that's not necessarily reflective of the real economy, even when you're looking at the S&P 500.
No, and you'd argue that the stock market never really reflects the real economy until it's too late. I mean, that's that the stock market is supposed to be a leading indicator. But I go back to, how do you define the stock market? I would argue if small caps are a much more important and powerful leading indicator to the state of the economy than large caps. Now, it's more than just sort of the tech versus everything else argument. It's also that large caps do have the benefit of these passive flows, which have nothing to do with the market being a discounting mechanism of the future. It's just mechanical. Small caps don't get the same benefit, which is why I go back to, I think small caps are a much cleaner signal of what's actually really happening. Again, I'm not saying that as a perma bear. I want to see small caps lead on the upside, because I think that would really confirm that, there's some big catch-up potential. The U.S. economy is going to be great, and it's going to be a phenomenal next several years. But again, we're halfway through a lost decade for small caps.
Yeah, it's been so tough if you are specifically in small caps. So I like that you're seeing opportunity there, and I want to get to that. So with the Japan, let's talk a little bit about why maybe it's Japan that's the problem. So how do you see this playing out for people who are not, I think anybody who kind of lived through that summer swoon we saw should have an idea, but what is the reverse yen carry? What happens in that scenario? Spell that out for people who may not always be looking at currencies.
So I'll give you a good, this is a true story. So I oftentimes on X, on at lead lag report, persona, loudness, act or not, I'll notice that people are engaging positively on content I put out, right? One of my clients said to me, I'm very good at making noise, and it's better to be talked about than ignored in the game of trying to get attention for a business or whatever you're trying to accomplish career-wise. So, I notice people are engaging positively, and I'll send them usually a direct message saying, listen, I appreciate the positive engagement. Usually I get a response back saying, you're great, love your work, followed you for a while. And I then always send a message back saying, hey, let's chat. What's your email? Right? And I do that because I do believe, as a general philosophy, that every relationship in life is like a lottery ticket. Like, you don't know if it's going to pay off or not. You don't know if it's going to be helpful for business, personal, whatever, but develop relationships, right? Just have connections with people. So oftentimes these are anonymous accounts. Like, I have no idea who these people are. I just get their email address.
Amazing.
I do a random Zoom with them. It's like and this is why I'm on calls all day long, right? I do 15 Zoom meetings on average per day, which sounds crazy, but is the absolute honest to God truth. which tells you I was lying about you being the only person I talked about.
Well, I know you well enough to know that.
Exactly. So I was talking to a guy. His video was a little grainy. He's from Honduras. And he's in his mid-30s. I'm just, appreciate positive engagement. We're talking camera to camera. So I said, so how'd you come across some of my content? He said, I followed you because of this reverse carry trade idea. I said, what do you mean? This is honest to God truth. This is an exact conversation I had with this guy, mid-30s. So he's a real estate property developer, owns a bunch of properties in Honduras. He said he's been doing the carry trade himself on a small scale, literally going to Japan, literally borrowing yen, converting it to his home country in Honduras, okay, and using that to buy property. Now, this is like a very small example. It's like and then it dawned on me, it's like when he was saying this, it's so much bigger than people realize. It's like, how many small players have been doing this for so long? It's beyond the institutional flows and all this stuff. You hear all these stories and all this data. It's like, no, this is so much more pervasive than people realize. So the whole carry trade concept is you get super cheap financing from Japan.
Which had negative rates.
Right? And for the longest time, it's a source of leverage because money can go anywhere. You get it in yen. You have to convert it to your currency. And then you can deploy that very cheap capital anywhere else in the world to make a spread. Very simple. Now, because you're borrowing in yen, if the yen depreciates and weakens, you like that because it means when you pay back the loan in yen, you can do it with less yen because your currency is stronger. Right? The debt load is fixed.
So no interest, and you get the...
Yeah, who wouldn't want that all day long? Where was I in that period? Oh, that's right. I was too busy struggling with my own strategies in a cycle that favored passive large cap. But the point is that it's like, okay, so then what happens when the yen appreciates? Well, money starts to get nervous that if the yen starts to run away, now that fixed yen debt that you borrowed to deploy elsewhere across the globe, well, now it's actually a heavier load on you, right? So what do you start doing? You start selling your risk assets where you deployed that borrowed Japanese capital and pay back in case the yen were to really appreciate. And that's what happened during the summer swoon, that August 3rd, August 5th scare, when I got all kinds of people saying, oh, the reverse carry trade, you were right all along. I didn't know when it would happen, right?
But you just saw the imbalance. This is very important. And for folks, we're going to get you if you're sitting there thinking, well, I'm not going to Japan and borrowing in yen and buying real estate someplace. This doesn't really impact me. It does, because you gave a very specific example, but the scale of this is enormous. And it's been going on for a long time. This was like the corporations, institutional investors, massive amounts of capital were doing this, right?
Well, and are still doing it. And this is sort of the comedy of all these narratives. It doesn't make sense to me at all. People are like, oh, the reverse carry trade got resolved in 2 days. How can it be resolved if it's still profitable? By definition, if there's an arbitrage, if something's profitable, it's still going on. Right. It's still profitable. As long as the yen doesn't super spike, which is the risk.
So we just got a little taste of what happens if that reverses.
Right. So who's to say it can't happen again? And that's what I'm saying. It's funny timing that everyone's looking at tariffs. And meanwhile, look at the yen. It was appreciating before this against the dollar, right? So it's like, who's to say it's really just not that? Now, by the way, I don't know if you saw that headline. I think Trump said Japan can something along the lines of Japan really should no longer depreciate its currency against the U.S. dollar, right? Because he's on this kick of non-market forces causing distortions in currency markets, which cause distortions in pricing for exports versus imports. It's almost like he wants it to happen.
Well, they do. The Trump administration wants a weaker dollar, doesn't it?
Arguably, yes. But you got to be careful what you wish for.
For other reasons, right. But this is why it's so complicated right now, because that knock-on effect is, even though it may help in other areas that they're focused on, it may have the effect of That's your concern, I suppose. That
Yeah, I think so, right? And now, of course, if you have that reverse carry trade dynamic, you're going to have yields drop. This is the other thing too. It's like part of the thesis around the reverse carry trade, which is why I kept on showing on X every time I show the Japan flag with the phoenix, and then the Doctor Strange holding the one outcome pointing finger. I'm ridiculously annoying almost every day putting that out there. That people have branded me as Doctor Strange on that. What's the whole phoenix, which I also wear, right, as part of my own gimmick? The phoenix is the flight to safety trade. It's the inverse correlation of treasuries to equities, which, by the way, if you haven't noticed, suddenly came back August 3rd, August 5th in that first reverse carry trade scare. If you haven't noticed, for the last 4 or 5 weeks, that correlation is acting inverse again, meaning when stocks drop and volatility rises, yields drop. When stocks rise and volatility falls, yields rise on equities, which is classic risk on, risk off, which has been lacking for the last several years. And part of the thesis was always that the reverse carry trade would spark that return. So again, I go back to, is it tariffs or is it behaviorally more about Japan?
Right. So if this happens again and Japan is a catalyst, first of all, what is the cause? Is it a dollar devaluation or depreciation, maybe intentionally by the Trump administration? Is that the catalyst that creates that reverse yen carry trade, or the unwind is probably a better way to put it, right? The unwind of the yen carry trade. Is that the catalyst, or you're looking for one? You just see it as a risk. You're not sure what lights the fire.
No, I think what really lights the fire, which is why I keep saying Japan will panic. I've been saying that also repeatedly. And if you have noticed the way the 2-year yields on Japan are rising, I think they're at 08 levels, which is a little ominous, by the way, because the reverse carry trade was one of the reasons that you had Lehman. There have been studies on this, right? It's the deleveraging impact of all that money. Not my opinion, that's just fact. If oil were to suddenly pick up aggressively, this has always been part of the thesis, that becomes a very severe catalyst. Japan's already faced with significant inflationary pressure, is way behind on the monetary policy side of things. It's like, if you were to market Japan's entire financial system to their GGBs, I can promise you the entire country of Japan is insolvent, mark to market. It's no different than during the regional bank crisis when everyone was saying the regional banks are insolvent because of treasury yields and the speed with which they rose. No different than 08, when suddenly there was a fear of the mark-to-market rule causing a panic because everyone said, wow, these banks don't have safe collateral, right? And against their leverage, right? Same thing with Japan, but probably far worse given how much debt they have as a system. So I think oil is still a very meaningful catalyst or risk, but it could be anything at this point.
So what does Japan do when you say they panic? What do they do?
I think so. So the whole thesis all along was that Japan imports all of its oil. Full stop. After Fukushima, they don't really have much on the nuclear side, and they have to power the country, right? So it's oil. Oil is denominated in dollars, so they have to convert yen to dollars to buy it, then back, right, on the Japan side. So if oil were to rise in dollar terms and yen keeps weakening, oil priced in yen becomes much more expensive because now it's not just oil rising, but it's the currency depreciation to have to buy more barrels. So it's a double whammy. Right? Now, Japan cannot control the price of oil rising in dollars. They can't price of oil. They can't control the price of yen by supporting and causing a spike in the currency, which makes oil priced in yen at least, maybe fall or rise slower. Right? So I think the panic is that they're going to have to raise rates very aggressively. And I think that can break the system for a moment. It's the global margin call. It is a reverse. It's the whole credit event thesis, which I was 2 years early. And I know people say, 2 years early is wrong. Okay, Michael Burry was 2 years early and wrong too until he was right. What matters is not being wrong. It's the magnitude of being right, period, in this game. It's why it doesn't follow normal distribution. So everyone is so stuck on frequency versus magnitude. You can slow down entering a storm driving. You are wrong repeatedly until the one time you're right and it saves your life.
It's a great way to look at it. So they raise rates aggressively. At the same time, maybe you have the U.S. devaluing the dollar, maybe not, but that's possible. And that sparks a capital flight back to Japan.
Right. And that sparks which is what you saw in that August 3rd, August 5th, fear trade, right? That sparks a forced selling of assets that are overly levered. Now, where it becomes problematic is where the leverage is in illiquid areas. And the illiquid areas tend to be private credit, tend to be high yield junk debt, tend to be spreads, right? And that's where I think, and that's why part of the thesis is that Japan would spark that spread widening of U.S. junk debt, which has been stubbornly tight, saying there's no default risk, while unemployment is rising at a pretty meaningful pace, and while small caps, going back to that being a real tell on the consumer and the economy, are clearly worried about default risk, right? I've never seen such a, talk about crowd mentality, I've never seen a complete refusal to even acknowledge the possibility that small caps are the real canary. And small caps do matter because it is the system. It is small businesses. It is the backbone.
So you see people deleveraging, risk off, spreads widening, possible defaults rising. Does that cascade throughout the entire market?
Probably. And it would probably result in gold selling off.
Gold selling off. Explain why. Because a lot of people, this is really important because I've had a bunch of people talking to me about the virtues of gold, and that as a place that is non-correlated to any of the other trouble in the global economy and the place to park your money.
I have been saying gold is sending a warning since October of 2023. And the warning has not been heeded, but gold's outperformed, and I've been very bullish on gold up until very recently. So there's two things. One is that I think this is the first time in the last month I've noticed that there's actually a degree of euphoria and overconfidence in gold, right? So, and this is what you'd expect after a pretty extended move. Nobody was excited about gold a year ago. I was one of the few guys talking about it, right? And that's just on the record, on my lead lag report research, on podcasts I've hosted, on podcasts I've been on, for all the talk about me being a perma bear. It's clearly not true because that trade was right. Now, in behavioral finance, there's this concept called the disposition effect. Okay, so disposition effect basically is this very real phenomenon that when investors are faced with uncertainty, they don't sell their losers because they want to get back to break even in their portfolio. They sell their winners. There aren't that many winners. Gold is one of them. I mean, tech peaks out in June for the most part.
Some people are sitting on some really big gains in tech, though.
That's true, and you can argue that there's still, but I think you need to break the AI is such a game changer mentality. I think for that to kind of unleash. But the point is that the disposition effect would argue that there's a delayed sell-off coming in gold because it's one of the few winners in the last,
and there'll be a bid for it. Importantly,
yeah. And now to be clear, I don't think that means like 2011. That's the end of the bull market for gold. I just think it's going to be a correction, right? Because I do believe that gold has been a beneficiary, and this is just the logical fact, has been a risk-off beneficiary of scared capital that has been nervous about treasuries. Right? It's like I always go back to the four horsemen of the risk-off trade are utilities as an equity sector, the dollar, gold, and then long-duration treasuries. Long-duration treasuries have obviously been horrible, which explains my own hell for my own funds because they rely on long-duration treasuries mechanically to be risk-off. That seems to be changing, which I'm thankful for because it's been a nasty cycle. But at some point, I keep saying treasuries will stand alone. If you get a real panic scare, gold is not a big enough market to absorb scared capital. It will go back into long duration treasuries.
Even with the very tricky debt levels that the U.S. has, because I mean, we're talking about Japan if they mark to market being insolvent. There are a lot of people who feel like the U.S. is not that far behind that, given all the borrowing we just had.
The difference is we have a military and the right to bear arms. Right, and the government has more arms than us individuals. I guess my point in saying that is, as long as the U.S. has its tentacles everywhere in the world, treasuries are going to almost always be the default safe haven asset.
You don't see that changing because this is very interesting. I think that part of what's worrying people who would normally be looking to bonds is the debt level that we're facing, the move to a more multipolar world, that you have a lot of people talking about the end of U.S. dominance and exceptionalism. Maybe you see asset flows that are moving back to different countries. All of those people are invested not only in mega tech, all those international investors and sovereign wealth funds, but they're also heavily invested in treasuries and dollar assets in general. You don't worry about that.
When Bitcoin worries about it, I'll worry about it. Because Bitcoin's not at the levels everyone is claiming it should be, given the impact on treasuries. Look, a lot. I think, and maybe this is part of my own communication strategy, so it could be purposeful. Hint, hint, nudge, nudge. I like to look for disconnects in narratives. It's not about being contrarian. I just like to see. I like looking for divergences because, in theory, from an intermarket analysis perspective, there should be consistent reasons for why certain asset classes move the same way. And the moment you have one asset class giving you a different message than another asset class, something gets resolved at some point, right? It just maybe with a lag. Okay, so if that narrative is true about treasuries, then why isn't Bitcoin at $1 million already? I don't. It doesn't make sense to me that treasuries are no longer the pristine asset when the entire system is still built on the risk-free rate. I think what's thrown everybody off, me included, candidly, is the fact that we just went through the fastest rate hike cycle in history. Treasuries totally failed as a safe haven play as credit spreads kept on tightening because Yellen was playing games with issuances. The Fed was taking liquidity away with one hand and Treasuries putting it in with another. I mean, they manipulated the ever-living crap out of bonds and liquidity, right? So you can only play that game so long. And as long as the U.S. government can tax, I'm pretty sure that if U.S. credit quality is terrible, all of us are terrible. They own us through taxation. Stop. Like this narrative is so silly to me that treasuries are no longer a pristine asset. It's tax day is coming up. I don't care that Trump is laying off all these IRS workers. We're still going to pay the man.
What is it? What are you seeing for the U.S. economy? I mean, are you watching economic growth? Does this factor into where you see opportunity, or are you more looking at these sort of dynamics between markets as what is the sort of most important thing to keep your eye on?
Yeah, I think it's more the dynamics. I mean, I'm not to be a conspiracy theorist, which I know conspiracy theorists will say. It's like, does anybody really believe any government data?
Well, you must think the economy sucks because small caps are weak.
Well, that's my point. Yes, of course. And by the way, if you ask small businesses, not publicly, they'll say, yeah, they haven't made any headway. It's more than just the argument of the K-shaped economy. Like something is fundamentally broken.
Well, I think you see that in voter anger, right? I mean, I think that there's
exactly right. I mean, you can see that it was obvious that Trump would win just from that perspective. It's like it goes back to a rising tide that does not lift all boats, everybody drowns. Okay, so in that case, it was the Democrats that drowned in the election. Yeah. But unless something dramatically, and again, I go back to I think deregulation has a shot at changing some of these dynamics because it has been very one-sided towards the big players.
So what are you doing? How are you playing that? If you see that as an opportunity, and it's very tough, right? It's the sequence of all this matters because I think that there are some plans which I think people see as a welcome disruption, but it seems like that's more of like a medium term to longer term issue, and maybe some of the risks are a little more front loaded. I think that's the worry when the administration and Bessent are trying to pull off the 333. But how would you think about positioning for deregulation? And do you think it's something that we'll see sooner rather than later?
Yeah, well, that's partially my own bet because there will be news on that soon. I do believe deregulation is a very powerful theme and one that I am hoping to create a different type of product around.
Oh, interesting.
That's a whole different conversation for another show.
Okay,
but
we'll put a pin in that and come back to you when you do.
Yeah,
come on and tell us about it. So some kind of vehicle that will be targeted toward the beneficiaries of deregulation.
Yeah, that would be the argument, right? So it's because it should be more small mid-ish as beneficiaries from that perspective, and a lot of historical evidence suggests that. I don't know. It's like the other part of this front loading is that you see all these people showing these charts. It's like Trump came in and messed up one of the greatest bull markets in history. No, Trump came in at one of the most expensive stock markets in history. Like, give me a break, people. Stop. Like, this is just silly. The guy came in to a very distorted large cap valuation starting point. It's not going to be his fault. It's not going to be his credit. Okay, it's cycles.
Yeah,
right.
Every president inherits a very complicated economic, but everybody likes to blame. They blame the last guy. Everybody blames them when the midterms come, but it's much more complex than that. I think
it's of course, which goes back to the crowd does not know how to define things at the extreme.
So you're positive about deregulation. You think there's some opportunity there in the small to mid cap space, and we will watch that space with whatever you come up with. What about oil? Because that's one of the pillars. They really want to get those oil prices down. You see that as much more a much
I
more
don't know.
difficult heat.
I think in general there will be parts of the energy sector that benefit from deregulation, right? Because on the drilling side, get permits maybe coming out faster and pulling oil out of the ground quicker. I just don't know that would fully counter a real economic slowdown where energy usage just plummets, like you typically see as a warning signal prior to recessions. So it's like, is the lower oil price because of suddenly more supply, or is it because demand just got crushed?
Yeah,
and I don't know, right? I mean,
and the reason matters, right?
Right, of course, yeah, the reason very much matters. So yeah, I don't really have kind of a strong opinion on what happens very short term to oil, which goes back to, that can still be a catalyst for Japan, but for all we know, oil does plummet, in which case it saves Japan some more time from panicking. But again, all this stuff is interconnected.
Right. So when you're looking at equities, do you see, obviously there's the risk, and if the Japan scenario plays out, that's a risk that can pull, certainly seems like very bearish for stocks, and it seems widespread and no one's really spared if you're getting margin calls. If you are bearish on large cap and some of these widely held names, is there a scenario where you see not a sharp decline or a bear market in stocks, but a rotation out of those? Is that your sort of bull scenario, that we see some of the mega cap weakness continue there, but it doesn't necessarily flee out of the US? We actually see a sort of return to some kind of diversification in some other sectors that have been left in the dust, getting some capital allocated.
So I think in general, when you look at value versus growth, value looks like it wants to lead. Right? It had this. If you look at a ratio of Russell 1000 value divided by Russell 1000 growth, it looks like a double bottom, and value is outperforming growth, which is really everything but tech versus tech. Really, value versus growth is possible. I think history suggests that rotations tend to occur in bear markets. Like if you get new leaders, it tends to happen into.
Okay, so there's going to be pain, but what comes out of it might be.
Yeah, I think that's probably right. I mean, I made that argument before. It's like it's like the circle of life. You need to have a recession. You need to have maybe a stock market crash. You need to have some kind of tail event to force the flight to safety into treasury bonds to force yields lower. That then saves small caps after refinance, and now they no longer feel higher for longer. So as much as it was painful, it solves the refinancing issue in that moment of fear. And then small caps come back, and it's a circle of life. It's like, in order to, if you crash stocks to save bonds, then saving bonds means you're saving small caps.
So you see small caps, you see opportunity equally in small caps and bonds.
Yeah, because I think it's very clear there. I think they're very interconnected, right? I mean, the more that yields rise, the more small caps feel the heat. The more they fall, the more likely small caps have a chance at survival. At least the zombie companies.
Is it too early to be in that trade? Do you feel like that's an opportunity now? Because obviously, if you're early, you get a good price.
Yeah,
but, as we've seen for the last 2 years, this cycle has a weird way of continuing longer than anybody thought it was going to.
100%. Yeah, I your guess is as good as mine on that. I mean, I think if you're going to dollar cost average, it probably makes some sense to keep tilting there, bid, high quality, small, just in case. And then, in a real bull market, all the garbage also runs like crazy, which means that the zombie companies would have massive moves, right, on the speculative fervor, which maybe is an argument for why you still have one more surge, right, where it's that junky stuff which really starts to finally work, and zombie companies are driving small caps, which causes another mania run. But I think fundamentals will ultimately catch up in that case.
Does your investment thesis work if the Trump administration does not achieve its economic agenda, and we don't see the deregulation, and they don't get the sequence right and strike that balance between devaluing and trying to get rates lower, but not sort of, throw a wrench in the global system where we see some large event that has all sorts of counterparty risks? Do they have to get it right for you to be right?
It's a good question. I think the endpoint has to be right. I think, to your point, the sequence. I always go back to path matters more than prediction, which is the sequence point, right? It's like we can all agree that the endpoint may be this or that, but how you get there is all that matters for investors, right? I think there's probably some element of truth to that, but I have no idea how that's going to play out. I don't know when. This has already been a weird year from a lot of perspectives, right?
And it's only March.
Yeah, it's only March, and even this decline is odd in the sense that it's like I'm a little bit skeptical that this is in quotes the big one, because I see a lot of people saying you're about to get your credit event, and it could very well be the case. And I only say that I'm skeptical because it's odd to me that junk that still is not selling off, and its spreads are just staying tight. So this is the biggest distortion going on right now, and the thing that everyone has to be paying attention to. It's the message of junk debt, right? And against the message of small caps.
Watch that. Watch Japan. What about geopolitics? Because there's a huge narrative out there, as I mentioned earlier, that you better start upping your international allocation. We're in for 15 years of the U.S. doing nothing, and this is the time for international, which has underperformed. Are you increasing your exposure? Do you buy into that?
I think part of that's related very much to the growth versus value dynamic. All right, so international tends to have a lot less tech, which means by composition of these averages, it tilts value just automatically, right? So I think it's more a question of, do you believe the next 15 years tech is going to lag? Because if you believe tech is going to lag, then the U.S. is going to lag. Large caps are going to lag. Small caps, international is going to lead. Right? So it's all the one question: what happens to tech? And tech is expensive.
What is something that would change your mind about? Like I said, you're not afraid to have a point of view. You're very convicted. You know that the timing has been a little off, but you're sticking to your guns on this. What would cause you to step back and say, "Wait, I got to go back to the drawing board"?
I mean, you see my shirt, right? The whole "I will not relent" thing.
I will not relent. Yeah.
Right? I wear that at conferences because I know people will recognize me because I say that on X all the time. It goes back to the only way the two messages which are at odds to each other, small caps and junk that gets resolved, is either small caps run like hell, in which case credit spreads are right, there's no default risk, zombie companies will survive, or credit spreads are wrong, small caps have been right this whole time, and you get a disruption, right? So, but one's very bullish, one's very bearish, right? So my thesis is not about markets going down. My thesis is that the disconnect has to be resolved with an extreme, which is why I keep saying, and it's not a play on words, it's not that I'm bearish on stocks, it's that I'm bullish on a tail event. Now, a tail event doesn't have to be negative. You can have a positive tail event with small caps running like crazy, like they did coming out of the COVID crash, especially during the election. As Biden gets reelected and you have the vaccine news, and small caps had this vertical outperformance run. It just didn't last, right? But that was like a tail event to some extent in a very short period of time, where you have to be in it before it happened very quickly. So I think we are due for an extreme. It's just not clear if it's going to be a bullish extreme or bearish extreme.
Yeah. And if we see small caps, the event that small caps are running, then presumably that means the economy, some of Trump's plans perhaps, or, for whatever reason, that the economy is doing well, that we get through this wobble patch, that the labor market doesn't collapse, and that the economy is achieving that growth rate that they're looking for.
In which case we may have a third term.
Michael, it's always fantastic to catch up with you. Thank you so much. I love the way you played out all the scenarios for us, and that you're not afraid to put it out there. Appreciate it. You will not relent.
It's my gimmick. It's my gimmick. Yeah, everyone's got to have a shtick. I worked for a family office once, and the patriarch of the family office was a $2 billion family, and the patriarch once came up to me and said, "You got to have a shtick in life." And he happened to be Egyptian himself.
But I'm going to challenge you on that, because I feel like you don't relent and that you are very hardworking. And we know you've completely transformed your physical health. And so I don't know. I think that's less a shtick and more who you are. I'm going to leave that.
But I think I always go back to I'm very public about this. I mean, the last several years have been hellish for me as a portfolio manager.
Yeah. Following
rules-based strategies in a nasty cycle where I never thought you'd have treasuries enter the worst bear market in history just as I launched my 2 ETFs. Yeah. And it's a cycle issue. The macro helps you to thrive. The micro helps you to survive. And that's why you can't relent. You got to survive long enough, hopefully, for the cycle to come your way. Yeah. We'll see if it does.
Yeah. I love it. Michael, thank you so much. We appreciate you.
Appreciate it.